Money is changing. For centuries, physical cash offered a simple promise. It was a tool for exchange that was largely anonymous. When you paid for a coffee with a coin or a paper bill, that transaction was a private affair between you and the merchant. No third party recorded the event. No permanent digital trail was created. This inherent privacy of cash is not a bug. It is a fundamental feature. It allows for a sphere of personal autonomy, small, everyday economic acts without constant monitoring. That world of simple, untraceable transactions is now facing a profound and perhaps irreversible transformation. Central banks around the globe are exploring a new form of currency. It is called a central bank digital currency, or CBDC. This is not just a digital version of the money in your bank account. It is a direct liability of the central bank, a digital token on a centralized ledger. The most significant shift is the potential for programmability. The money itself can be embedded with rules, how, when, and where the money can be spent, turning money from a passive tool into an active instrument of policy and control. The history of money is a story of evolving abstraction, moving from tangible objects to digital records. It began with physical items of value, like shells, salt, precious metals. These were replaced by coins and later by paper notes, which represented a promise of value from a trusted issuer, usually a government or a bank. For most of this history, the dominant form of exchange was physical cash. Handing someone a coin or bill was a direct, peer-to-peer transaction. Its key feature was that the transaction itself left no data trail. The money moved, but no central database logged the identities of the parties involved. This privacy was the default state of commerce. The advent of commercial banking and electronic payments began to change this dynamic. When you use a debit card, a credit card, or a bank transfer, you are not using physical cash. You are instructing a private financial institution to move funds on your behalf. These transactions are not private. Your bank keeps a detailed record of your spending, and so does the merchant's bank. However, these systems are fragmented. Your bank has your data, but it is a private company governed by privacy laws and regulations. It does not automatically share every detail of your life with the government. The reason every transaction in a CBDC system can become a permanent piece of metadata lies in the basic technical requirements of a secure digital ledger. First, to prevent fraud and ensure integrity, the system must maintain an immutable record of all transactions. This is the very definition of a ledger. Every time a digital token moves from one wallet to another, the event must be recorded to confirm the new state of ownership. This prevents double spending and creates a verifiable chain of custody. Its value comes from its permanence and resistance to alteration, turning a momentary payment into an everlasting entry in a database. Second, security in most digital systems relies on unique identifiers. To access your digital wallet and authorize a payment, you will likely use some form of cryptographic key or digital signature. This signature is your unique mark in the system. It links your identity, or at least your wallet, to every transaction you initiate. While techniques like zero-knowledge proofs can obscure some details, the fundamental link between an action and an authorized actor often remains. Your digital key becomes a thread that can be followed through the entire ledger. Third, large-scale systems involve extensive logging and backups. Admins need detailed logs. For disaster recovery, ledgers are regularly backed up and stored across locations. Even if a record were deleted from the primary ledger, it would almost certainly persist in secondary systems. Data redundancy makes the transactional record not just permanent, but pervasive. Immutable ledger, unique cryptographic identifiers, and comprehensive logging combine to transform every payment into a durable piece of metadata. From the perspective of a government or a central bank, the arguments in favor of a traceable CBDC are compelling, rooted in the promise of a more efficient and stable economy. A programmable ledger offers unprecedented speed and precision in implementing monetary policy. Funds could be sent directly to the digital wallets of affected citizens in an instant, bypassing the slow and often cumbersome bureaucracy of traditional banking systems. A fully transparent ledger provides a powerful tool for combating financial crime, money laundering, terrorist financing, tax evasion. In a system where every transaction is recorded and traceable back to a source, such illicit activities become vastly more difficult to hide. Regulators could use sophisticated algorithms to scan the ledger for suspicious patterns, flagging potential criminal behavior in real time. This could dramatically improve law enforcement and increase tax compliance, potentially recovering billions and enhancing national security. Programmable money opens new possibilities. Tax collection streamlined by automatic remittance at the point of sale, and subsidies for specific goods could be automatically applied. These functions promise frictionless commerce and administration, saving time, reducing costs, minimizing human error. A real-time ledger offers a bird's-eye view to monitor activity with impossible-to-date detail, enabling more responsive, targeted policymaking. The same features that make a CBDC attractive for efficiency and control also introduce profound risks to personal liberty and freedom. When every single payment creates a permanent data trail, the sphere of private life shrinks dramatically. Simple, everyday actions, buying a particular book, donating to a political cause, paying for a medical consultation, meeting a friend for coffee, become data points in a government-controlled database. This creates a chilling effect. If people know that their spending is being monitored, they may avoid purchasing certain items or associating with certain groups, not because their actions are illegal, but for fear of being misunderstood or flagged by an automated system. This constant surveillance enables a new and powerful form of social control. A programmable currency can be used not just to track spending, but to influence it. During a public health crisis, a government could block purchases of items deemed unhealthy, sugary drinks, tobacco. During a climate emergency, it could limit spending on gasoline. While intentions might be good, they represent a significant intrusion into personal choice. The power to permit or deny a transaction based on government policy turns money from a neutral medium of exchange into a tool for enforcing behavior, creating a society where financial freedom is conditional. Consider a journalist paying a confidential source. With cash, the source is protected. In a fully traceable CBDC, the ledger creates a direct, undeniable link, putting the source at risk and silencing future whistleblowers. The development of central bank digital currencies is not merely a technical upgrade. It is a critical juncture that forces us to confront fundamental questions about our society. We stand at a crossroads between two competing values: efficiency, security, control offered by a transparent financial system, and personal liberty, autonomy, dignity. This is not a decision that should be made behind closed doors by central bankers and technologists alone. The design of our future money demands a broad and inclusive public debate. The stakes are too high to proceed without a clear consensus. Citizens must get clear, honest information. We need to move beyond technical jargon and discuss the trade-offs in plain language. What specific privacy-preserving technologies will be embedded in the system? Will there be limits on what transaction data can be collected and stored? Who will have access to this data? Under what circumstances? What legal and constitutional protections will prevent abuse? Robust legal frameworks are essential. Strict limits on financial surveillance, independent oversight with audit powers, guarantees against discrimination or suppression of dissent. The architecture of liberty must be coded into the law, not just the software. A CBDC can enhance inclusion and efficiency, but it can also become the most invasive surveillance mechanism ever created. We must demand a system that balances progress with privacy.